Hi everyone, my name is Jeff Salas with Salas Weighing LLC in Chicago, Illinois. I'm making this presentation in connection with my article with Wisconsin Lawyer Magazine about investment fraud and what investors can do. This discussion is not to make any investment recommendations or to pass judgment on any stockbrokers or anyone who is currently invested in something or something they don't know what it is. This is simply a guide that we use when looking at abusive investments. The first part of my article is who does this happen to? It happens to everyone, is the short answer. Elderly folks are definitely of more concern. What's happening is throughout the country, stockbrokers are bringing older folks in their office and selling them investments that really don't make sense for them. One, because the investment is very risky. Two, because the investment is illiquid. And three, because these folks need money now, or they need some sort of consistent return because it's their retirement money, and they're not looking to really make a lot of money. Now these investments are risky, and that's not really the problem. The problem is people aren't being told these investments are risky. Stockbrokers are telling them these are safe investments, when in reality they're very risky, they're very illiquid, and folks are having a hard time getting their money back. Now there are a number of common themes in how these investment, I wouldn't say fraud, but investment abuse works. The first is a lot of times that they are coincide with a luncheon or a dinner. A stockbroker invites 70, 80, 100 people to a dinner, buys everyone a steak, and then asks them to listen about some investments. Now those investments oftentimes are generally pretty risky. The reason they're selling you these investments is because they're being paid sometimes a very high commission to sell you a very risky investment. And the reason that happens is because the companies selling shares of their company are paying high commissions to brokers to raise capital. And when that happens, they end up trying to fill shares with folks who probably shouldn't be buying those particular investments. Another common theme is something that we see a lot is trust. The stockbroker gets you to trust him or her, and old folks come in, they trust them, they're buddies, and all of a sudden the money is gone. And there's a reason for that. The reason is the stockbroker wants to sell as many investments as possible to as many people as possible, and they're really not doing a service to each client. Now, how do you prevent this from happening? The first way to prevent it is to do research on your stockbroker. Now, stockbrokers are regulated by what's called the Financial Industry Regulatory Authority, also known as FINRA. And FINRA has a website where you can check out brokers and see if there's any complaints on the record, what their background is, what their education level is, as well as a number of other things about their firm and themselves. You can also check out the SEC website, which is the Securities and Exchange Commission. And the Securities and Exchange Commission sometimes keeps tabs on financial advisors and the complaints against them, the capital their firm retains, and other specifics about that particular stockbroker or brokerage firm. The second way of preventing this is really to make sure you know what you're investing in, and really getting a second opinion from another stockbroker. Between brokers, you may end up with two that are selling similar investments, which could be a problem. But a lot of times, if you're looking at different firms, you're going to be getting sold completely different investments, and that goes to show you kind of how these are working. It's not really working for a particular person; it's working for whatever the firm is selling at the time. Another thing to prevent these is a real smell test. If it's too good to be true, if it sounds too good to be true, it is. High returns do not come at a low risk. Now, if you lose money with an investment or investments or a whole investment scheme, there's a number of things you can do. You can bring an action in state court, you can bring an action in federal court, but most likely, if your beef is with your stockbroker, the forum you have to bring it in is in the FINRA Dispute Resolution Forum, the Financial Industry Regulatory Forum, through an arbitration process. Now, in that process, the investor files a claim, is obligated to produce some documents. The respondent, the brokerage firm usually, is compelled to answer your claim, and you move forward to an arbitration final hearing. There's no depositions, so it's a very streamlined process. Discovery is streamlined, and so it's a good remedy for investors to move forward and really try to get some money back for unsuitable or abusive investments. Now, how do you know if you have a claim in FINRA or a claim against your stockbroker or brokerage firm? The first thing you look for is you lost money. I lost a bunch of money. My portfolio was X amount. Now it's X minus $100,000 or $50,000. That's your first clue. Now sometimes it's a product of the market, and I assure you, When you call your stockbroker or brokerage firm, they're going to say it was a product of the market's going bad. But what it comes down to is that a lot of times you are in bad investments or bad products. Now, certain ones to look for. First of all, if you have a limited partnership, it's an LP after the name of your investment, that's not a good thing. That is one red flag of you have a bad investment because it's illiquid, it doesn't trade on the market. Another thing that we look for is non-traded real estate investment trusts. These are also private companies that aren't traded on the market and are generally illiquid. Illiquid meaning you can't get your money out of them easily. It's kind of like your house. When you have a house, in order to get the money out of it, it's not a liquid asset, you have to sell it, you have to go through a process of selling it. Same thing with a lot of these investments where you can't easily get your money. You can't just sell it in the market and then get your money back. Another thing we look for is excessive trading. Excessive trading is a major problem. Colloquially, it's called churning. And what happens with excessive trading is your account gets traded over and over and over and over again. And the way to look for that is look for a lot of trades. Really look for thick account statements is really what we look for. If you only have X amount in the market and your account statement comes in looking like a book every week, every month, there is a chance that it's being overly traded. Now, excessive trading is something where a lot of times folks lose money on it, a lot of times folks don't, but you still may have a claim for excessive trading, even if you make money, because a lot of times this trading is meant to ramp up commissions for the broker or the brokerage firm. And when that happens, you still have a claim for those commissions, because a lot of times these commissions can be in the hundreds of thousands of dollars. When bringing a claim in FINRA, the most common claim is something called suitability. The concept of suitability requires brokers to recommend investments that are appropriate for each investor. Now, the broker has to make a kind of a dual inquiry. The first is whether the investment's appropriate for anyone, which for a lot of these investments, it may not be. But they also have to make an inquiry into the client or the customer to see if it's appropriate for that particular customer. And there's a number of factors, including net worth, age, risk tolerance, investment objective. For many of these products, brokers don't do that. They sell the products, they're told what to sell from the brokerage firm, and these products get sold without a real suitability inquiry. That is one of the main problems with the product-based claims. There are a number of other things we look at when talking about suitability. One is a customer sophistication. Now, there are very sophisticated investors out there, folks who have advanced degrees, folks who are stockbrokers themselves, folks who are financial advisors, people in the financial world who know what they're investing in. Now, a lot of these investments are made for them. They're made for people who know how to put together a portfolio, people who know how to invest their money, they know how to read prospectuses, and they know how to assess their own risk. Now, those claims are much tougher than the claims for folks who are unsophisticated. Now, sophistication, financial sophistication, and normal life sophistication are often two different things, because a lot of times folks think they are more sophisticated than they are, in that they know what they're getting into, they know how to invest, they watch Mad Money all the time, so they know what is going on. The truth is that unless there's a real careful study and due diligence done of each investment, your sophistication really depends on your perspective, and the perspective often is coming from somewhere where you don't know what this investment's about. Unless you've studied the prospectus, you've studied the due diligence, you've really looked into the company. And for a lot of private companies which people invest in, very difficult to determine the prospects, the risk of that particular company. Now, also in FINRA, there's a host of state law claims you should, and federal law claims you can bring. You can bring claims under your state securities laws or blue sky laws. You can bring claims for breaches of fiduciary duty. You can bring claims for negligence. You can also bring claims for breach of contract, negligent supervision by the brokerage firm, and a host of any other claim that you may have. Any claim that you can bring in a state or federal court, you can bring in the FINRA forum. The opposite doesn't necessarily apply. Bringing FINRA claims in state and federal court are kind of subject to that jurisdiction's rules. Many of you probably think, how often does this occur? What is the scope of this problem? I think the problem here is of epidemic proportions. A lot of times, small town America is being sold investments that are risky, that go down quickly, and that often leave customers in poverty. And a lot of our clients end up in poverty and come from all walks of life. Our clients are farmers, teachers, coal miners, and MBAs, business people, accountants, folks who were sold one thing, they put their trust in a stockbroker, and the stockbroker sold them one or more risky investments. This is a problem that goes well beyond what folks think, simply because the incentive here for the brokers and brokerage firms are commissions, and these commissions are very high in the riskier products. There's not much of a commission for selling safe investments, simply because the companies that are safe, they don't need the brokers to oversell these investments. They get sold no matter what because they are safe. The products that we see that are abusive are high commissions. One thing to ask your stockbroker is what they're receiving in a commission. Anything that you're looking at 3, 4, 5, 6, 7% commission is very high for the broker, especially when you talk about putting your entire retirement into a security. Now, a lot of these come with fees beyond the stockbrokers, meaning that sometimes 15, 20% of your investment could go towards fees before your investment even reaches the company. Now, what I'm talking about here today goes beyond the Ponzi schemes. It goes beyond the straight-up investor fraud or theft. We're talking about investments that are appropriate for some folks, but only appropriate for maybe 1 to 5% of the country. We're not talking about the theft. That is a completely different inquiry. That's also very important because I think seniors and folks in general are getting scammed every day on a theft basis. These are not theft. They are breaches of fiduciary duty, they're negligence, they are suitability issues, they're broker, misleading brokerage statements rather than something that is a theft. If there are 3 things to take away from my article and this discussion is, 1, investigate. Make sure the stockbroker has a clean record, make sure the firm has a clean record, and make sure the investments you're buying aren't overly risky. 2, if it's too good to be true, it is. Be very careful in what you invest in. And 3, you do have rights if you do lose money. And so if there's losing money or there's churning going on, you have rights in FINRA and other forums. For more information about these topics and some specific case law, you can read my article in this month's Wisconsin Lawyer called Retirement Down the Drain, Financial Elder Abuse.